The Gourd Show is sponsored by Ellipsis Labs. Ellipsis Labs is building a world where mainstream finance happens on-chain. Their first product, Phoenix, is a fully on-chain limit order book DEX on Solana doing hundreds of millions of dollars in volume. I know this team personally. It's one of the strongest in the space. If you're interested in working with a team that's here to stay, Ellipsis Labs is hiring engineers passionate about DeFi to join their team. You can find Ellipsis Labs on Twitter at ellipsis_labs or head to ellipsislabs.xyz to learn more and apply. Hey guys, today we have Ludwig from Sorella, recently launched an open source MEV dashboard called Brontes, also working on a Uniswap hook or extension thing called Angstrom that should be coming out soon. Very, very smart person who I talked to a good bit. I think he has about as good of an overview on MEV and trading on Ethereum as you're going to find. Welcome, Ludwig. Would you like to tell us what you're working on? What you just launched, and then, what you're going to be working on.
Thanks for having me, Guo. Always a pleasure. So recently we launched Brontes. So Brontes is basically an open source block explorer for Ethereum that is focused on systematically identifying various forms of MEV. And so the main focus for us was that we're obviously working on finding solutions at the application layer towards the various forms of arbitrage and different forms of extractive practices that occur. But we wanted to gather as much data as possible. And given the complexity, to be able to translate that to the general audience, we thought that the simplest way was to just show them what was actually going on. Because we couldn't find any live data on SexDex arbitrage. It just wasn't available. I'm sure the top players definitely built something out to measure the P&L of their competitors. But apart from that, you really had minimal insight. And so how we went about building this was we tried to get as big of a coverage as possible to look at really most forms and then also try and identify the longer tail stuff and trying to gather and integrate all of the metadata and off-chain data that you could possibly think of. So now it's launched on GitHub. You can interact with it. You can run it yourself. You can download the data and you can kind of play with it. There are a few assumptions that are baked in, and we have all the documentation, etc. But it's mostly built so that as a community we can kind of test the assumptions that we've made and try and actually gather the best way to identify this stuff. So zooming out, the main rationale for why we built this was we were really interested in demonstrating that data, but we also wanted to integrate it with our main product, which is Angstrom. And what Angstrom is it's a Uni V4 hook that depends on an off-chain network of nodes that are just sidecars to like an Ethereum client, and that run this application-specific auction to sell off the right to arbitrage these pools, and at the same time form, similar to what CalSwap solvers do, a unique uniform clearing price for a pool for an entire block so that regular users can't get sandwiched.
Nice. Okay, can you quickly tell us what forms of MEV you're tracking, like SexDex, sandwiches, and then also briefly as well, break down just like what those are, just if you don't mind.
So we track primitive, like we call them like the base types, and then like the complex, like composition types. So for the like base types, we track SexDex, liquidations, although there's definitely a little bit of work to do there, but it kind of bored us, so we skipped over on that. Sandwiches and atomic arbitrages. So long tail atomic arbitrages, cross pair atomic arbitrages, and also just like triangular regular arbitrage. And so to explain each of them, a sandwich is when you send out a transaction, it becomes public in the mempool. Some attacker identifies it, realizes that they can buy before you, and then that pushes the price of the AMM. You're buying at this inflated price, and then they back run you. For an atomic arbitrage, there's some price discrepancy between two decentralized exchanges, mostly caused by poor routing, and then an arbitrager basically rebalances those prices. But there's actually some fancier stuff that goes on. And I think the most interesting and the most creative segment of MEV today is probably in the atomic arbitrage space. And then for SexDex is basically the why it happens and how it occurs is that you have Binance that runs super quickly and they're basically trading in continuous time. And then you have the decentralized exchange that updates its prices in discrete increments because it is constrained by each block. And so it's only at a block by block kind of speed that the prices actually update. But in times of high volatility, but even in general, like trading days, the price between the decentralized exchange and the centralized exchange can differ quite significantly because the price on Binance has evolved. There was some information, prices moved, and then the decentralized exchange and the liquidity providers there don't have that information, and they're selling and they're offering their liquidity at these wrong prices. So the arbitrager will simply just buy on the decentralized exchange to sell on the centralized exchange or vice versa.
Okay, I wanted to ask before we start digging into the spicy stuff. I want to ask about. So you said there were some assumptions baked in with Brontes. So, for example, like the SexDex when I was looking, right? So you guys take like the Binance mid price, right? Is that correct? And then you compare this to the pools on chain. So you're seeing what is like very oversimplification is that what the price is on Binance, and then you compare what the arbitrager bought it for, sold it for on chain. Now, I want to ask though, in terms of like your confidence levels on each of these like various forms of MEV that you monitor, where do you have like very high confidence? Like SexDex may be an example where like Binance is very deep liquid market. You're probably going to have the right price for the asset or whatever at any given point. Whereas like some of these other assumptions you may bake, I'm curious, like, where do you see your like the highest confidence level in terms of this is how much MEV is being extracted versus like down to the lowest, like this could be it, but we really have no idea, right? There's a lot of stuff that goes on and off chain.
Yeah, great question. So where we're most confident, I'd say is probably Sandwich, the Sandwich MEV inspector, because it really pretty clear cut.
Because it's insider trading. No, just kidding.
It's pretty fucking obvious. You know? JIT sandwiches as well, which are like a combination of a just-in-time liquidity attack and a sandwich. That we're like extremely confident on that. On SexDex, we have two methodologies. We have one that I don't like as much because I think we're missing a bunch of arbitrage, but it works quite well, and it's just like when we did data analysis with various market times, looking at that instantaneous mid price we don't just actually look at Binance, we look at the most liquid exchange for that pair for that month. And that like gives pretty solid results. Yeah. And one thing I'd say there is that what frustrates me with that methodology is that you are missing out on a bunch of weirder SexDex. And we saw that, when we implemented our experimental SexDex methodology, which is like, has a bunch more assumptions baked in. This is probably lowest confidence in the underlying assumptions. The results are quite good, but like it was very much trial and error, where instead of just looking at the mid price, we're taking a volume weighted average price over a dynamic time window, which is centered around the bid submission time. So when the actual builder sends the bid to the relay, and then expands first after the block and then in stages and then before the block up to the point at which it is identified enough volume on the centralized exchange where the arbitrage is legible. And what I really liked about this part is that the more degenerate stuff that you never think was actually SexDex because you look at the tokens and they were just absolute dog shit were actually like pretty systematically SexDex. And we gained really high confidence in it actually being SexDex because we saw like direct deposits to KuCoin or OKX in the transaction itself. And where we were sending these transactions to a guy on Twitter, he's called Gaussian Process, and who does a fair bit of SexDex. And he was like, yeah, of course, do you not see like they're literally sending to the centralized exchange. And so that was really funny to see. And then the one where I'm most wary about the results is the atomic arbitrage, because we cast an extremely wide net because you can't like really pattern match that well on like detecting atomic arbitrage, because there's so many different ways that as soon as you try and like narrow it down too much, you're missing all of the really cool stuff. And we really built this because we wanted to see the crazy stuff. And basically the problem that occurs is that we had to build our own like custom pricing module that would like basically collect the state of all of the pools that were created up to that point within like the historical, like basically we're looking at Ethereum's block history at that historical block. All of the pools that were created before on the protocols that we support were the ones that we had state loaded for them. And then we could basically search this token graph where you had the pools interconnecting them to find the price. And that like whole pricing module ended up being like extremely complicated and has this very niche bug that we don't have the bandwidth to fix yet, but we're looking to do it as soon as Angstrom's out, where like for some extremely low liquidity tokens, it just goes awry. And the other kind of explores what they do, and it's a smart solution. They just prune those. So if it doesn't meet like a liquidity threshold, they just get rid of them. But we didn't want to do that because we realized that a lot of this stuff, although the P&L was incorrect, they were actually arbitrages. So that's where like in P&L figures, atomic arbitrage, take it with a big grain of salt for sure.
Interesting. Okay, so now let's like just dish. What is the most? What are the like? What stood out to you building this Brontes dashboard? Like what? I don't know. You can just start rambling, but like what stood out to you? Maybe some assumptions you had made that turned out correct, or some things that you saw and you're like, "Whoa, this is insane! I had no idea this was happening on chain."
This is something that I mentioned a bit in the past, but the one thing that like was kind of the first thing that jumped out was like, oh. Like when I'm talking about SexDex to people, we're all under the assumption that this is like ETH USDC on like Uni V3, top tier, the best of the best crypto assets, because these market makers are never going to hold these crazy tokens. That is wrong. That is wrong. These guys, the big boys don't do it that much. At least from what I've seen, like they kind of stick to their majors and they're the best on the majors, and the P&L. If you look at like who's making money and which pools have like highest extraction, it's definitely the majors, because the pools are so much deeper that you can push so much more, and so you can effectively like make more on these arbitrages, although it is way more competitive. But a lot of these like smaller players are focusing on these lower liquidity tokens that are not listed on like the tier one exchanges, and they're making really good profit margins. And I don't believe that they are like vertically integrated. I think that they're just like running separate shops. And I think that when we talk to people, I know you're in contact with quite a few of them as well. Like, and yet they're like, oh yeah, I'm doing SexDex, and you're like, really? Like, are you really making money? Like, my guy right here, he seems pretty competent. Like he's building like 80% of blocks on Ethereum or something crazy. How are you actually making money? And I think it's through that. I'm not sure, but that's kind of a main hypothesis there.
That's interesting. But let me ask you quickly on that topic. Do you think that that's like sort of encouraging for people who want to be searchers? Like, is that like, would you consider that to be generally encouraging? Like if you find a small niche like this, there's a lot of ways to print money still, even without, being vertically integrated. Oh, okay. Never mind. No. Then. Go ahead.
Don't become a searcher. Like it is an absolute waste. Like I have I guess there are two things to this. The first thing that I'd say is like, I think we're still extremely early. We saw it with Manta Builder, which was Jane Street. They did a great job. Like they were really good. And the reason they were really good is like, once you get past I have to trade on a blockchain, I have to like run a node and I have to send to a builder, and then or I have to run my own builder, which they were doing. And the builder has to build the block, and then I have to send it to propose. Once you get past all that, which you can realistically just hire 2-3 guys that have done it in the past, pay them more than the firm that they're working at, and they'll do it for you. And then you upskill the entire team there, and like now you guys have the knowledge. The biggest and the hardest thing is really, okay, where is price going to go? How much risk am I willing to take? And that is all something that they are going to be better at. like Citadel is like a strategy allocation team.
Yeah.
You know, it is like optimizing where they allocate their capital into which like various strategies is bigger than like the DeFi, the DeFi side of SCP and Wintermute, I believe. And that is just in like, okay, who within our firm are we going to allocate money to, and how can we optimize this? Which is like kind of mind-boggling when you think about it. Like as soon as the big boys can come in because there's some form of regulatory clarity and there's enough money in the game for it to be interesting, because right now, quite frankly, it's peanuts for them.
Right.
And they will wipe the floor with everyone. Like that is at least my belief. And that is not to say that the people that are doing it now are not in a great position and won't be in a great position then, because they'll probably just get hired by them. But yeah, it's kind of something that we saw at least at Sorella. I was like, this stuff is so much more fun. Like I love to be building bots all day and like trying to compete with people that I know on chain and do a bunch of crazy stuff. But it's not like, they're already pretty well entrenched and we're not likely going to win now. But even if we do, there's going to be back and forth competition. And then we're really fighting between like lower skilled individuals in the grand scheme of algorithmic trading and finance at large. And then they come in and they wipe the floor. And so then it just doesn't seem worth it. The other thing that I'd say is like looking empirically at the data, what you see in the different forms of MEV is that sandwiching and sex DEX are extremely competitive, especially for the majors. When you see bots that have more than 1,000 bundles that are included, I can put up the exact numbers, but the numbers, like the number of bots that have that many bundles included over time reduces like extremely significantly. Where, let me see. It goes from like a like relatively large number of like 300 to 100 to down to less than 50. So you can already see it. And when I say less than 50, that is not to say it's a 50 like separate firms. Like you can think of 5, right? So there's like a huge like there's huge friction in which like these guys get churned out and they get pushed aside because they cannot compete and they're clearly out of the game. And so they're like, if you want to make the bet on MEV and go for it and have fun or like live through the pain of having to design all this stuff and work on it, definitely don't go there. The one thing that was surprising to us was atomic arbitrage. Atomic arbitrage is where you really see a lot of different contracts, a lot of new addresses, and they're like frequently active and making good profit. And I don't know if that is because atomic arbitrage can be so large and there's so much creativity involved because there's so many new protocols. You know, you have the arbitrage between these various new wrapped assets and you have to interact with it in a really weird way. And there's just a ton of complexity there where you have to have this super specialized strategy. And because of that, like there's just more people that can enter the game. Or simply because those strategies are so specialized that you benefit from having a specialized contract for that strategy where these people are actually the same. So that I don't know. I'd assume it's a bit of both, but it definitely seems like a better thing to do, which I think somewhat goes against like common wisdom in terms of, atomic arbitrage is like the most competitive. It's all arb to zero because it's riskless, blah, blah, blah. Like that's not really what we saw when you cast like a super wide net, because there's a bunch of like funky stuff that you can profit over.
Let me ask you this. Okay, so just like to be somewhat naive here. And when I say naive, I mean, this is also because I don't actually know. When you're saying atomic arb, you're talking about like on-chain pools to on-chain pools, as opposed to centralized exchange order books to on-chain pools. Does on-chain pool to on-chain pool include like Arbitrum, Optimism, or is this strictly on Ethereum? Okay. What do you think the likelihood of this like cross-chain MEV occurring as well? No, it's not there yet. Go ahead, ramble. Let me hear it.
Okay. So two things. So it's not like cross-chain pool to cross-chain pool. Oh, I buy a I sell A for B, and then I sell B for A, triangle, boom, I made money. Like that stuff's kind of like, that is competed away.
Okay.
I'm talking like funkier stuff like, oh, this gold pegged stable is equivalent to this other gold pegged stable. And if I call a redeem function on this contract, I can, burn this asset and get this other asset, and there's some arbitrage there. And I think we are abusing the definition of atomic arbitrage within our classification, because it's really a wide net where it's like, okay, they made profit atomically, but we're not constraining them to have come back to the original asset. So that in some sense, the value of the assets they hold is higher, but they most likely would have to like sell it off in a separate transaction to actually capture back into like USD terms and be back into like a stable coin denomination, if that makes sense. So I'm really like using the term like quite liberally, but it's more on the funky stuff that there's a lot of stuff. To answer the cross-chain DEX arbitrage question, I just don't see it. I don't see it ever like being that significant. Maybe there are edge cases. I'm sure it's happened. I think it was more like of an intellectual exercise for the searcher, rather than them profit maximizing. Because why wouldn't you just do it against Binance? Like, if they're assuming Ethereum SexDex is hyper competitive, Ethereum's going to get arbed to Binance price. Okay, now you're going to arb the optimism pool to the Ethereum pool's price, but the Ethereum pool's price is the Binance price. So you could just do that Binance optimism arb. It's cheaper. You already have inventory there. It seems so much simpler and like far more efficient. And because it's the race to zero, right? Like that small gas fee, that small, swap cost is going to make the difference.
Okay, let me ask you about this. Like the large firms, I honestly have no idea about this either. The large firms, right, who are doing SexDex, do they get like very preferable treatment on Binance? Do they get like kickbacks and like reduced trading fees? And is this, would you say, like a very high economy of scale here, where they can have like all of this liquidity and get like really good execution and low fees to enable SexDex? Like, is this a big aspect of it? How much like there's like they have on these, big centralized exchanges that can like get very good execution? Like, what are your thoughts on that in general?
The simple answer is I don't know.
Yeah.
I don't want to speak on things that I just don't have visibility on. What I could like loosely gather and really like, again, huge grain of salt, is that like, I mean, the Binance has like this market making tier that they mention on their website, but it isn't public. So you don't know what their actual fee tier is. Some of these like less liquid exchanges that are, nowhere near like Binance level volume offer like far more
like rake back. I view it like very much like rake back in poker, right? Like you do a lot of volume, especially on these like mid to low tier exchanges. Like then it can become something that may not have been profitable can all of a sudden be profitable. But I don't know how much this plays in the MEV. You know what I mean?
I definitely think it does play, because if you're competing, right, and like you're bidding and you want to minimize how much you're paying, you can the proposer will select the most valuable block. You can afford to pay more if you made more money, simply put, because you paid less in transaction fee, like in trade fees.
Right.
So it definitely makes a difference. I'm not sure it is like the 0 to 1 for everything. It probably is for the majors. Again, I'm not sure. Maybe like there are some players that have like such strong alpha that they're just better at seeing where prices are going to go. And that makes a far bigger difference than the actual, difference in trade fee that they're paying. For the low, like the more degenerate stuff, I don't think it makes that big of a difference, because there's just not that many people that are holding that stuff anyway.
Yeah. For the, like you were talking about, like in terms of the alpha of these trading shops, like what, and I'm not sure exactly if I'm going to phrase this correctly, but I think you'll understand what I'm asking. What percentage comes from like pure and I'm saying percentage, and once again, like I don't even know if that's the right way to ask this, but like what do you think is the big edge? Is it in being able to trade, or is it in being able to arbitrage? Is it like more of like taking on inventory risk now, or is it strictly in arbing these pools? Like in terms of the top builders, like where is this headed, and like what do you see right now?
I think it's the being able to arbitrage is the prerequisite, and then it ends up being able to trade.
Okay.
It's like, okay, we both have the big boy pants and the big boy shoes. We both have like 10 million that we can dish out on a single transaction. Okay, now who has better edge? And I think it then becomes, but in the beginning, it's simpler and less, like probably less significant. But at the same time, like on these like less competitive stuff, on these less competitive assets, the question there is it actually simpler because now you have this like super unpredictable, somewhat garbage asset that you have to hold on your books, and then, but maybe they just don't hold them for that long, which is probably what I'm thinking as well.
Thanks for listening to The Gort Show on the Blockspace Podcast Network. Subscribe to our newsletter at blockspace.media to get the show directly to your inbox. Show links, transcripts, and Bitcoin articles twice per week. Stay ahead of the conversation by visiting blockspace.media.
Okay, we've seen Beaver like take a pretty big market share as of late. I think the most recent like pie graph is that they're winning over 50% of blocks. What happened to rsync? Do you have any? Can you give me some hints? Like I think a lot of the intuition, like from others that I've talked to, Uri, of course, who solves MEV every week, says it's the private order flow, man. I'm telling you, and I'm sure this is like a big aspect of it. What do you think? Like from what do you look at the composition of like the big builders right now? Like, give me some insight. Like, what's your intuition?
I heard a key player left.
Okay.
I'm not sure how important that was. I don't know. If that made like a big impact, it might have been like, cause and effect, decline. And then, but I honestly don't know. The other thing is, I'd say there's definitely something to say about, Yuri is right there, like you mark out some of these like other forms of MEV and you're like, like given how much they're paying the builder, they really shouldn't be making money here. And this is not sex DEX where we don't know what the price they're actually trading at is. This is, a sandwich or, like an atomic arbitrage or a liquidation. It's like, it seems like you guys are overpaying a tiny bit here. And there's also, the uninformed flow side of things of, we're getting a bunch of flow from these routers. And obviously that plays a significant role in terms of like the builder economics. Like these people that are using these Telegram bots, like want to get included really quickly when they don't actually really need to. And they're willing to overpay a lot. And that's super valuable to builders. So I think that it wouldn't surprise me at all if there were definitely deals on the table. I'm almost certain that there are. I don't know if it's Beaver. I don't know if rsync, but I'm guessing that most of the major builders have some form of private order flow deal with the people that are just bringing them like significant order flow. It's natural. I think that it evolves that way. And I don't think that we should sit here and look at it and, paint them as the bad guy. Like this is something that always frustrated me in how we kind of think of vertically integrated builders and how we think about, searches in general. I love trolling on Twitter and like painting them as like super evil, blah, blah, blah. But really like it's mostly banter. Like we can't blame them for extracting on a system that has these fundamental flaws and where the incentives are just leading towards that anyway. Of course, like they should. I think that they're completely in their right. Maybe not necessarily for like the more like outrageous sandwich stuff, but for like general forms of arbitrage, I think it's completely natural, and we shouldn't like paint it in that light at all.
Are you a fan of the MEV accelerationist view? Is this like
what is that view?
I think I don't want to put words in people's mouths. Also, I'm not sure that these are even the words that the people who I think would say, but I think the notion is allow, I don't know if allow is even the right word. There's going to be maximal extraction, and then we build around that. And yeah, I think that over the long run, we see apps, designing for less extraction. And I think there was this sort like maybe, I'm not articulating this very well. Maybe it's like, okay, well, we start with the Wild West and we see where there's these inefficiencies, and then they get hammered down over time to the margins. Like, has this generally been a good trajectory? I think there's been, I guess the reason I say this is because there's been some criticism of Ethereum that, you've really let the Wild West take place versus, at least, yeah, well, or at least like maybe there was some belief that this stuff. Well, also maybe I think some people thought this would like work itself out quicker, and in reality, like we've seen some pretty egregious, stuff on chain for quite a while now. And yes, I don't know if you have thoughts. Like,
I sympathize with like the idea of like, in the beginning, we don't know like the extent of the problem. Trying to build like very specialized solutions to it, it just seems like an infinite rat race. There's so many different protocols, so many different ways you can make money and extract value from users. Like, holy shit, like there's too much. Let's just generalize it and then ensure that the incentives, like there's some form of incentive alignment between like the baseline proposer, the builders, and the searchers, so that the chain at least can work, even though it is really extractive. And I think that view was taken in, was made like with all of the right intentions in mind. I think a lot of this like criticism is pointed towards flashbots, but at the same time, we wouldn't like be discussing all of this stuff if they hadn't like originally put the absolute put all attention towards it, and made it so public. Where I do agree with people though, the MEV accelerationists, is that when you look at the data, it's not that important in terms of value. And this is, I think, mostly Yuri's point, but it is also always the same stuff for 99% of it. And so where I slightly differ in opinion with Yuri is that I think he says, okay, we can do this altruistically because it's just not that valuable. And because it's not that valuable, like we can just all kind of coordinate and find some incentive alignment where we don't have to do it because it's better for our long-term backs. I think it somewhat makes sense, but I think I would go like somewhat further. I'd say it's not that valuable, but it's also always the same stuff. 99% of it is the same thing. Although we'd love to think we'd love to think of Ethereum as like this, computer for all that we can do everything on. Right now, it's mostly used for trading and for like financial applications. So the extractive part is really focused there, and you can just design those applications to mitigate those specific forms of extraction, and you've cut down on 99% of it. And yeah, you'll have the like one-off crazy thing that happens, but it won't impact your everyday users, and people won't care because it's really just the super niche stuff that hasn't become enough of a problem for a smart application designer to care about solving it. And that's a point at which I'm comfortable with.
Okay, let's quickly talk about private order flow. Like, it does seem like you said, there's more than likely almost every big builder has some, order flow origination deal. And I'm curious if you think that this is concerning. Maybe you can go ahead and answer that, and then go ahead. Is that concerning? No, is this like a net positive?
So it's so normal. It's so normal. It was bound to happen. Like natural, right? And how can you blame the person who's providing the order? I am providing a value to you. You derive value in having my orders because that means that you can bid marginally less. You can provide value back to me where I pay less fees. I pay less priority
Yeah.
So it is really normal. One thing I would find scummy, and I don't know if any of them are doing this, where it's like a service provider, and that service provider is doing this on the behalf of their users, but the users are paying sticker price, and then they're pocketing the difference. And I don't know if anyone's doing that. It'd be pretty funny if they were, but that for me would be really scummy.
Do you think from an ideological level, users should know that their order flow is being sold?
I think I disagree with the framing. I think they should know if it is sold. I think that applications should be designed so that there is minimal value or like little to no value in actually setting them. And what I mean by that is you can extract some data. There's some information that they can get from it. But this whole, I auction off like this transaction and it's really inefficient. And then, some more sophisticated person prices things better, routes the trade better. And then suddenly, I can pay you back. I can refund you. Like all of that to me is psyops, because the reason that they're paying you is because your initial, execution sucked. And like we have the means to make this better. Like we can bake this into the underlying system. If we put enough effort, we can get very close to like near perfect routing. Like a lot of these things seem to come from a place where the application just isn't doing its job properly enough. And because of that, the users would, if they're not super sophisticated, get a terrible deal. And then there's like, they're leaking extreme value. And then, we can set off the order flow. I do think there's some exceptions to that, but in general, that's how I see it for most of like the MEV auctions that I see today. I really don't like that whole framing of, basically what I discussed. Like I'm sending you something and, I got ETH back. Like, no, you didn't. You executed poorly. And because 3 bidders were there, you got 40% of what you actually would have lost paid back to you. So great. It doesn't seem that incredible to me.
Yeah, sometimes people like the idea of rebates, though. It's like almost more alluring. It's like, you get a little like, you know what I mean? You get some money back, but in reality, it's because you're getting screwed on the initial execution. Okay, well, I want to move on then a little bit to Angstrom. So what is it? What is Angstrom? And then I'm going to also pry about Uni V3 and then Uni V4, how it's going to be designed. So if you want to just tell us, like, what is the DEX that you're building?
So Angstrom is a DEX that aims to solve sandwiching, recapture some value in atomic arbitrage, but mostly really recapture a bulk of the value that is leaked through DEX arbitrage. And how we do that is we have these pools on Uniswap V4 that are connected to an off-chain network of nodes. So as I mentioned previously, they're sidecars. They basically run next to and like are integrated with an Ethereum execution client. And those sidecars extend the baseline like P2P capabilities of Ethereum, where you can now send these new message types to this specialized mempool. And that allows us to have this entire network basically run this auction where we can auction off the right to execute against the LP, but also collect all of the user transactions and form a like single uniform clearing price for a batch. And so why that is useful and what's actually valuable in that is that for your liquidity providers, they're lacking information. They're selling or buying at the wrong prices, and you want to bring that information back. Using an oracle is gonna be laggy. Dynamic fees will never be able to like capture to the full extent of the auction because they have to have some max cap, and they will also discriminate other people that could have just been uninformed traders, although in expectation far less. So really for us, the simplest and most elegant solution was running that auction where we can pit all of these participants against each other so that they can compete to pay the most back to the LP, so that at the end, the LP ends up trading extremely close to what the true price is, because you can think of it as, oh, I'm executing this arbitrage. Really, my rebate, my bid back is just how much more I'm giving back to the liquidity provider, which translates into what my effective swap rate is. So what my actual like execution price is. And if you bring that as close as possible to true price, the LPs are just getting a better deal. On the uniform clearing side, for regular user orders, the main benefit there is that it's ordering agnostic. So you don't care about if you're first or last in the block. It's all within a single transaction, and all like internal orders within that transaction for all of these users are executed at the same price for that pool. And the cool thing there is that you use both the pool liquidity, which has been rebalanced by that competitive auction. So, in expectation, if it's competitive, it's going to be extremely close to true price because the arbitrager is incentivized to do so. But at the same time, you also have off-chain market makers that can provide their limit orders, similar to what they do, on centralized exchanges, and add to that on-chain liquidity with their off-chain liquidity. And then you combine all of that, and then you get your single price.
So now I'm going to go back to the question that I said I was going to ask. What is the big unlock between Uni V3 and now Uni V4?
I think the big unlock is really just like hooks.
Yeah.
It allows you to customize things. So the singleton part, so there are two big parts, right? There's the singleton, which is, okay, we now have only a single contract, Uni V3, one pool, one contract. You have a factory, you can like kind of spawn up a bunch of pools, relatively easy to deploy, but it's fragmented across a bunch of these contracts, which is mostly a gas thing. But there's some cool things that are done on the accounting which I really like what they did. They're like Uniswap kind of cooked on their accounting model. It's very elegant. And then with the singleton, what you have is that single contract contains all of the pools and tracks their internal balances. And with the addition of the hook, you can now create your custom pool, which will call a separate contract of your choosing that can run any arbitrary logic. And you can think of like any form of use case there where before a swap or before you add or remove liquidity, you do some arbitrary action. And so for us, it's verifying who's actually trading against the pool. So is the person that is trading a staked validator within our network, so that we can ensure that there's no bypassability? Because of course, our system falls apart as soon as anyone can interact with the pool, because there's no reason for them to bid back to the LPs. There's no reason for them to respect all of the rules that are there to protect the liquidity providers.
Okay, if it's such a great idea, why isn't Uniswap just doing it themselves? It's kind of a layup.
Which one?
Like this, for example, this hook, right? Like that you're building. Why isn't this something that Uniswap just integrates directly? Like, why don't they just ship this?
It's a great question.
Is one like, do you have, I mean, I am curious, like, is this take like a, I mean, I understand the premise of hooks, right? Like enables more customizability. What do you think is like a reason why the Foremost DEX isn't shipping directly with stuff like this integrated? Like why do you need to come and build this hook, right?
I think that they're going towards a direction where they want to be, the lower layer,
okay, yeah,
general layer. I see this repeated quite a bit. I think it's like the market, like the internet market, like the market for everything.
Yeah.
And I think that it's a smart view. It's like there's a bunch of people that might know more about like specific niches in trading and all of this stuff, and like maybe NFTs or whatever. Or like really complex DeFi strategies, and they can all build on this base platform. And they have the like user retention of like users interacting with their app through their wallet. They keep them within the ecosystem, and they benefit greatly from people innovating on it. You're harnessing like the aggregate like intellectual power of like the DeFi community, which I think is really powerful. The other thing is they're building a lot of stuff at the same time. Like we care only about this. Like, yes, we built Brontes, but Brontes was really like verifying our assumptions and discover and like gaining more insight into this, and also finding an interesting way to show the problem and show the extent of it. They're building the wallet. There's rumors about them having their app chain. They have the mobile app. They have Uniswap X. Like, that's a lot of stuff to maintain, and it's just natural. Like, it just seems more logical to me, at least, for them to focus on like the core element of each of those and do those really well, and let people kind of build on top of it.
Okay, so then I'll ask you sort of the inverse of that question. If LPs will get much closer to fair value on their side, and then users will get better execution because this is executing like as one sort of aggregate transaction, what made you decide to build this as a Uni V4 hook instead of just spinning up an app, which, okay, cold start problem, blah, blah, blah. We can talk about like network effects, liquidity, blah, blah, blah. But at the same time, like, if it's clearly better, why aren't you just building a DEX, a standalone DEX, atop Ethereum? Like, is that a reasonable question?
Yeah, no, I've had this question a lot. There are a few parts to it. We, like, 99% of complexity in this is in the backend. You're building a node that runs in parallel to another node, has its own mempool, has its own auction mechanism, its own consensus algorithm that is optimized for this specific use case, its own slashing rules, its own accounting logic. Like, you're basically building close to building an extremely purpose-specific rollup that has the additional complexity of running within the execution environment of Ethereum, and with all of the baggage that comes with that, PBS, all of that often adds quite a bit of difficulty. And if we build this, that for us is where the value is. Like, we don't see that the underlying smart contract hook implementation is valuable. You can copy it. It doesn't matter. Like, for us, we don't care as much on that side, although it's like extremely important that it be done correctly and safely. That's not where the source is. The other side is, we don't want to be, building a custom, implementation of an AMM specialized for our specific constraints, and then having to audit it, and you have all of this tick math. It's complicated. They're like pretty prone, to vulnerabilities, especially when you enter like quite complex math in like on chain and doing so gas efficiently. Like, there's a lot of stuff that kind of gets a bit wonky there. So we didn't necessarily want to put that risk on ourselves. And we saw it when discussing with LPs. Yes, there's the like network effect of, I trust like Uniswap, there's a lot of liquidity. But a reason for that as well is like, they have like an immaculate track record in terms of security. If you talk to any LP and you tell, for us, like, the discussion was very clear, was you are not taking on any additional risk in terms of loss of funds by entering within our system. Any portion of the code that holds your funds and that holds your liquidity is designed and audited by Uniswap, which have invested millions of dollars in getting the best of the best to like review and review again.
Yeah.
And personally, I'd much prefer focusing on like what seems to me is the fun part than like auditing the accounting model 50 times,
Yeah. When people interact with Angstrom, will they go to Angstrom.io? I don't know. I'm making this up as I go. Dot what? XYZ?
XYZ.
Okay.
I think the shout cash for the .io. No, it's crazy.
Okay, I was just like throwing out a guess there. So they'll go to angstrom.xyz, right, to interact directly with your front end. Is that correct? And then the liquidity is sourced by Uniswap. Yeah, you're like kind of feel it. So go ahead. How does it work?
Liquidity is within our pools. So a liquidity provider has to provide liquidity to our specific pool.
Okay.
The thing is, that pool is within the Uniswap V4 singleton. It is. I have created a pool on Uniswap V4 singleton. It is the Sorella. It is the Angstrom pool. It is connected to our off-chain network. The off-chain network can kind of bundle transactions to then create these execution payloads. but the liquidity itself is just directly provided on Uniswap V4, but declared to that specific pool.
Okay.
It's not declared across the board. It is like exclusive to the Angstrom pool.
Okay. And then you talk about, the staked, like those who want to interact with the network have to put up a slashable stake. Who are these people? And how many nodes do you expect to run on this, just out of curiosity?
There are a few kind of profiles that I'm thinking of. Trading firms.
Yeah.
If you want like your edge, quite frankly, like you want to trade as quickly as possible on it, there's significant liquidity. You have an incentive. Then the other side of builders, you want additional order flow. You can kind of ensure that you get that order flow through this. And finally, I guess like also just align like traditional node operators that are familiar with running like AVS style systems.
Who are the LPs on Uniswap currently?
No clue.
Why does nobody know the answer to this question? Is it because they're losing money and they don't want, like, nobody wants to be the what? I mean, this is insane. Everybody's got this like little smirk on their face when I ask this, and it's like, why does nobody know? There's this one guy on Twitter, you know who I'm talking about, who is convinced he's been printing money by LPing on AMMs since day one, okay? Since UniV1, okay? Outside of this, nobody admits to being an LP. There's a tremendous amount of liquidity in Uniswap pools. Why does nobody know? Why is this like, it's like a secret, but it's also like everybody kind of also doesn't know, and it's insane.
I think maybe the people that do know don't want to tell you because they want to keep the access to liquidity to themselves.
But are they making money?
But they're making money in different ways.
Right. Okay.
They're most likely making money in ways that you're not seeing.
Right.
And that I'm not seeing, and that will never be visible on chain.
Wait, what do you mean? Wait, hang on. What do you mean ways that you're not seeing either? Is this not likely related to some type of MEV activities?
No, I don't think so. Exception to that, but I'm talking instantaneous liquidity. This was, okay, small side note, but it was echoing something that Max mentioned the other day, where like we're under this impression that SexDex is only bad for LPs. It's actually also terrible for swappers a lot of the time, because market makers now realize that they could provide liquidity instantaneously, so that the transaction, you're not actually paying the swap cost. You're clearing a user trade that is trading against like the Uniswap pool, and the price is discrepant, and you're offering the liquidity and you're taking the other side of the trade. But now you're getting paid the trading fee. So you can do it within the fee bound. And you can also just do it in a setting where it just maximizes your P&L, because they're pushing the price like to a further discrepant point. So small aside there, like TLDR, SexDex can actually be really bad for swappers, and we see this in practice a lot with the big boys. But to answer your other question, I'd assume they're making money through like some form of backdoor deal, because liquidity is like, end of the day, like the bloodline, the thing that keeps it all going.
It is like, I would just make a quick observation here. I know there's been like some suspicion that like venture firms, some of their larger backers are the ones providing liquidity. And if you are trying to bootstrap, this makes a lot of logical sense, but I don't have any proof of this. But what I would say is there's something a little bit bizarre that this is supposed to be the future of permissionless capital formation, and nobody knows why the people who make the markets. Like, that is sort of a bizarre concept. Like, from somebody who's observing from the outside and who has asked, go ahead.
Sorry, I interrupted you, but
no, go ahead.
I think we do know. I think we all know. I think we're pretending to not know, but let's be real here. Or it's crime, which I don't think is like the major element.
Or it's crime.
I do not think that like the majority of it is crime. You see it with like hackers, and I love seeing this stuff. It's like, oh, Ronan, a hacker, is like buying this random token and like providing a shit ton of liquidity, and somehow they actually end up making money. Like, they're the rare ones that are quite good at it for some reason. and then maybe like some, darker crime. I don't know. I don't want to like put my tinfoil hat on. I don't know, but some of it seems plus. But the other like most obvious thing that I'd see is like, we all believe in this thing. We all know that at some point we'll solve these problems, or at least we hope. Otherwise, there's no point in investing so much of our time in it. So we might as well, like as big and like taking the like position of a major investor in the space, we might as well, eat the cost of, providing this liquidity, because we have a strong belief that this will be the future of finance, that this specific application will be so important that we'll make it all back and 1,000 times over. I feel like that's the only like really logical thing that I'm seeing. Another explanation that I've heard, and I don't know how much I believe this, is that there are some people that raise like LP funds where they're like literally like liquidity providing on Ethereum or on other chains, and they raise capital and they're just taking their 2 and 20 and they're deeply unprofitable, but they just use the like marketed APYs to keep the funds, and they're just milking it out dry. I don't know if I believe that though.
It's kind of like, once again, I'm not putting on my tinfoil hat as much as I am just saying this as an outside observer. It's interesting to look at this and say, oh, okay, like we're bootstrapping, right? Like we're still in the bootstrapping phase. But the problem with this is like, if it's not, and also this isn't a rag on you, nor is it nor am I trying to criticize Uniswap or any like AMM design, but if it's not clearly sustained, I guess it's just hard to say like, oh, we'll figure this out, when there may just be some like insurmountable problems with the fact that Binance ticks really, really fast and Ethereum ticks every 12 seconds. And I don't fault you coming in and finding like what is like clearly an interesting solution, but I do see a lot of this like really brilliant people like yourself coming in and solving problems. Don't get me wrong. So I do, from what I can tell, like you and Nesloban, and like solving these like sort of intricate but like very real problems. But then we zoom out and we're like, wait a second, like in a sense we could almost look at AMMs as like all incentives, like all like has been in one big bootstrapping phase. And it's like, well, when are we going to exit this, guys? So I don't know. You don't have to respond to that. I'm just, as like somebody who like knows just enough to be kind of like, I don't know about this. You know what I mean? I do look at this stuff and I'm like, well, I don't know. Like you can say like, we'll get to a point where it's like clearly sustainable, but it's hard, I guess one thing, and this is the nice thing I'll say, is that the notion of like permissionless capital formation, it's interesting. I have this discussion with Doug Colkett a lot, right? Like he and I, like we go back and forth on this, but I think he believes in it. Like he genuinely believes in it. And to me, it's like, okay, it's interesting. I don't know if it's gonna, solve all the world's problems, but it's interesting. So I will concede that.
I disagree on the idea that a bunch of like smart people are coming and trying to find solutions, as in like myself included, like a lot of, like, not to say that like these people aren't like really smart. They definitely are. But I think that a lot of the time with a lot of this like extremely, jargon heavy stuff.
Yeah.
It's not complex so much as it's filled with prerequisite and like high volume contextual knowledge that is required to even understand why the problem occurs. Like SexDex as an issue is not that fundamentally complicated to understand. If you know, like, oh, blockchain works like this, block come every 12 seconds, Binance trade every second. Like that stuff is not like, we're not doing the craziest stuff here. We are not, revolutionizing, like the world of physics. Like this doesn't seem like we're anywhere near the point of like, oh, this is insurmountable. And I'm not saying this is like general to crypto. I think this is somewhat specific to DeFi. I think that there are a lot like smarter people that are going to come in as like the access to this knowledge is going to open up, and they're going to do an even better job and an even better job. And I think that over time, we're going to realize that right now we're just early and we have a high context, but we're not that smart. We're not that smart. Like we just know and happen to stumble on this thing and, went down the rabbit hole. But I think like I could probably explain this to my, you know, like my little sister if she was willing to listen to me ramble for like a month, you know, and just get all the context. But once I give her all of the context and then I show her the problem, she's like, oh yeah, it's pretty obvious, you know. And that's why I just don't think that we're at the point where it's like, oh, you know, let's give up. And I don't think that's necessarily what you're relaying, but it doesn't feel like these problems are that, you know, insurmountable.
Okay, that's reasonable. Yeah, that's an inspiring. We're early. That's the only thing I took away from that. We're so early, dude.
Not on your backs. Like the VCs have way better like entry.
No. We're early on. Don't kill the pod, dude. We're early on the bags too. Okay. The last thing we got to talk about is just your overarching thoughts. You and I were talking about this before the episode a little bit, but like your overarching thoughts on protocol design, right? Like a couple weeks ago, I have Max on, and he's like, you know, we're going to change the L1, like we're going to make it great again. And you, as an app designer who, yeah, like functionally operates atop the L1 and would like to see more activity come to the L1 again, right? Like trading occur on the L1. What is your intuition? Like, what are you looking at with regards to the roadmap? Like some of the conversations that come up recently, like how do you feel about a lot of like some of the changes, proposed changes or lack thereof within the Ethereum community?
Yeah. I think generally I try to like caveat a lot of my opinions on this with the notion that like, although I might know a little bit about MEV and DeFi, I'm not necessarily like the deepest expert on like specific, like very cryptography heavy elements of the roadmap.
Yeah.
And there are definitely problems that I'm not necessarily seeing in terms of longer term scaling issues that are likely going to arise. And I think that the EF, for all its flaws, does a pretty good job at like thinking ahead and saying, okay, this might give us a marginal benefit today, but is this remotely endgame? And I think endgame is somewhat of a meme like in this context, but like remotely sustainable with the ambitions that we actually hold in terms of scaling and usage. So with that said, the one thing that definitely frustrates me with a good part of the Ethereum community is this, you know, meme that is repeated across the board about, you know, we need to be World War III resistant. We need to, we need to save the Soto staker. We need to be able to run stuff on a Raspberry Pi. Like I'm echoing a lot of Max's comments here, but I definitely agree with him there. I feel like the roll-up centric roadmap makes sense to some extent, but we're killing the L1 when we don't have to. And there are a lot of really cool developments on like the L1 node side in terms of performance increases and also just changes to the protocol that could enable for, you know, both. You know, we could get a like decently performing L1 that will still like necessarily be cheaper, but we're pretty happy to execute on. And we saw it post EIP 4844. Like transactions got substantially cheaper. I haven't seen a transaction in recent times where I paid a fee and I was like, wow, this is ridiculous. I never want to use this again. Like it's been way better. Like there's clearly progress, but I'd love to see more progress on the execution side. I would love to see more focus on, dealing with a lot of the legacy tech. This idea, the EVM is, it's ossified. We're all used to it now. Breaking changes are terrible. I hate. I really, really push like strongly against that stuff, because to think that like the original VM design that was clearly like not the best, has a lot of like problems in terms of parallelization, etc., is now suddenly the de facto because our super niche community that currently exists, it got used to that, and that we shouldn't evolve. It just seems so wrong. Like imagine if the first people to make like computers were like, you know what, this is good enough. Let's we're used to this, we're comfortable right now. Like let's not make new stuff and let's not have developers like learn new things and continuously push the boundary. Like how I see this is like crypto in general, like blockchain tech at large has to be significantly better, not just better. We have to do a lot more because there's a lot of added complexity. There's
added cost.
added cost, but also in terms of political sway. Like, it isn't necessarily an incentive of certain large institutions to adopt blockchain technology because they're somewhat disintermediated. And given their current political sway, it has to come from, the voters. It has to come from everyone. We have to all be able to sit here and say, this is so important that I, as like a random Joe who isn't like deep in DeFi or made a shit ton of money on crypto and suddenly care because my bags will go up, care because there is a fundamental use case that they see in their daily lives and know that it would make their life better. And for us to even be able to remotely do that, we're competing against Web 2. And Web 2 will push the frontier. They will continuously try to evolve. They're far more nimble in that sense. Okay, not everywhere, but you think of the startup world, right? Like, you're willing to break things, you're willing to try. And I think that's the like energy that I'd love to continue to see and see more of. But it's easy to say, but it is harder to be the ones implementing it and thinking of like the 1,000 possible, vulnerabilities that could arise from any form of change and, breaking changes and all that. Like, it's hard. It definitely is hard, but it's definitely possible.
Is there anything that stands out to you? I don't know, multiple concurrent proposers, like Fossil, like any of these MEV specific roadmap or discussions within the Ethereum community? Is there anything that stands out to you as being like, yo, this would be very bad for me? And even though you seem willing to iterate like on the grounds that if it's net positive for the improvement of the world computer, whatever you want to call it, then we can adapt. But is there anything that you look at and say like, this would be horrible? Like, I don't know, a roll-up centric roadmap would be like a big one, but I'm maybe more specifically with regards to MEV stuff. Is there anything that you see and you're like, yeah, this would break what we're trying to do?
Not really. I might just be ignorant, but I'm not like here. Like, we discussed like implementation and like the idea. End of the day, you boil it down. We're saying, users, like apps, don't have control of how their user transactions get executed. The proposer does. The proposer wants to maximize their revenue. They don't care about the user. The app cares about the user because they want the user to return. Let's give the app back the control of how the users get executed. Like, obviously not like just arbitrary magic wand. I get to decide who wins, who loses, but there's some form of like robust mechanism that ensures that, or at least optimizes for, user outcomes. You can implement that in 1,000 different ways depending on the constraints. If like the constraints change and new things arise, like the goal is still underlying the same. And so I don't think that like the big changes that have been proposed in like the MEV space would directly conflict with that vision. I think that we're all somewhat going towards that, and we just disagree on how we want to implement it. I think for multiple concurrent proposers, one thing that got me really excited, like I was like genuinely smiling when Max described this, because I thought it was like really cool and would have made my life actually way easier, was the execute as you need, where you basically you treat the L1 as like a bulletin board, but you don't just have like priority fee sequencing, which I think is not a long-term solution. A bit better, but not great. But instead, a transaction basically communicates a flag that declares ownership to a specific application, and that application can then collect all of these transactions as the block gets executed, instead of executing them one by one, and then use the app-specific logic in this form of like super contract, where you can think of it as in, these are all the things that are happening and are interacting with the app on this, like in this block. Let's take it, process all of it, run like our specific logic, and then output what the actual execution is, like what the state transition should be. So AKA, you have a bid, I have a bid, and they're all transactions. The app then takes all of these bids, and then we decide who the winner is, like the logic outputs the winner, and then your specific balance gets updated because you got to actually execute the swap. And that's what was really cool to me, is like, oh, like we wouldn't have to do all of this complex, off-chain stuff. We just implement it on-chain, and it would be so much easier. But obviously far more costly, far more gas inefficient. There are UX problems as well. It isn't like all rainbows and sunshine, but I thought it was a really cool idea. Problem is that it demands like a fundamental overhaul of the EVM, it seems, at least.
Yeah. Okay. Well, are you generally encouraged with the direction of the roadmap? Would you say, like, do you think a lot of this stuff? Once I know you said you're somewhat ignorant to this, but I am too. So, like, are you optimistic that some of these changes come about soon, or you still think there's like a good bit of pushback? Maybe.
I think I'm optimistic.
That's good.
I think if my answer was any different, like, what am I doing here? Like, and I think if anyone's answer is different, like, you should probably move to another chain or become like an advocate to do everything to change it, because otherwise, like, what's the point?
Yeah, I mean, I think you could reasonably say, like, we'll see what happens, and if some of these changes don't come about, we will go elsewhere. Like, I don't think. I guess what I'm saying is, as an app designer, you do have a bit more dexterity, I guess. Maybe the argument is like, yeah, it's like an overhaul of, like, it would be more difficult to launch for you guys on the SVM, right? Like that would be a massive overhaul. But I'm just saying, like, as an app designer, maybe you do have a little bit more of like you could say, I'm still going to be here. And if it's not, like, if some improvements aren't made and we don't see, like, even something like, if we don't see liquidity, I think, yeah, you see what I'm saying? So I don't know. I think you do have, I'm just saying you have range of motion is what I'm saying.
Yeah. I think I was somewhat interpreting this as like, I was being a bit Ethereum centric.
Okay.
In the sense, it was like, oh, like, if this doesn't work out, like, what's the point in, like, if I have no faith in us, like, eventually solving these problems, given like that we're so far from the goal, what's the point in investing so much of my time in working in this in this field of technology in general? But your point's extremely valid. Like, there are other people that are like aiming towards a similar future, that are operating with radically different assumptions and radically different, approaches. And I think that's a great thing. So yeah, I definitely hear you there. But I'm optimistic on Ethereum, but I definitely have like a soft spot for Ethereum, I'd say. But I look at like Solana, and I look at other chains that are doing interesting stuff with like a very keen eye. I don't think that we should see this as the be all end all, especially if it ossifies and it refuses to kind of evolve, and it does a Bitcoin. And I know that you're a huge Bitcoin bull, and we differ greatly in our opinions on that. But I think that'd be such a shame, and then I'd definitely make the jump.
Yeah. All right. Well, that was an inspiring way to end. Thank you so much for coming on. I thought this was great. A lot of in the weeds, which is good.
Thank you for having me. This was a lot of fun.